So once again, very good evening, everyone, and welcome back to the session. So we will be starting with our marathon session from today onwards. So we'll be going through almost all the important questions, as well as we will also be quickly brushing through all the important relevant topics that will be applicable for the coming September exam as well. Okay, and let's start with the session directly as we are running out of time because we have got a lot of area to be revised. So, well, we know that when it comes to the paper AAA, there are some important areas which we need to focus on. Especially, there are some important areas from the area of 25 marks question, as well as we have got one important question from the area of 50 marks as well. And out of these three areas, we'll be focusing on the 50 marks area today. We'll also be practicing a full-fledged question from the area of 50 marks as well, which will cover almost all the important areas. So actually, we had our revision classes in the last week. I know that, but still, as part of this question practice session, the first half an hour probably we need to dedicate that time specifically for the purpose of revising the prior topics, because then only we will be able to practice the questions properly. All right. So let's start with the area of 50 marks question. So basically, when it comes to the area of 50 marks, which are the most important topics that usually used to be asked for almost all the exams? Other important topics. First, yeah, definitely it's the area of risk. But when it comes to the area of risk, there can be chances of having further split down there. Either it may be a question on the area of audit risk. It can also be a question from the area of risk of material misstatement. Then again, it can also be a question from the area of business risk. Any of this can appear for your exam. And when it comes to the risk of material misstatement, it can also be a combination of risk of material misstatement and analytical procedure. Okay. In addition to this area, next one, it's the area of audit procedures. Then there can be chances of having question from the area of ethics as well. So these are the core areas. In addition to which, earlier we used to get a question from the area of additional information. So we'll just quickly brush through those areas as well. So these are the most important topics of the 50 marks area. So in addition to these areas, the important thing that you need to keep in mind is that the 50 marks question is not just a question for risk. I always used to mention that the 50 marks question is not just a question for risk. It's a combination of risk, audit procedures, and ethics. So definitely there are possibility where you might be getting more marks from the other areas than the area of risk. So you have to give equal importance for the audit risk part. In addition to which, you must also give equal importance for the audit procedures, ethics, and other requirements of the 50 marks question also. And when it comes to the 50 marks, well, we know that out of the 50 marks, there's only 40 marks for the descriptive part. Rest of the 10 mark will be for the professional marks. So the professional mark can also be easily scored. You need to consider multiple things while appearing for the exam. Definitely we'll discuss about that later in today's session itself. But still, there are multiple factors to be considered. So now we will focus only on the core areas, which includes the area of risk, audit procedures, and ethics. Okay. So let's start directly with the area of audit risk itself. So basically, when it comes to the area of audit risk, the examiner might be asking you to identify and prioritize the significant audit risk that might be appearing for the exam. Either it might be a question on the area of audit risk, or it can also be the area of risk of material misstatements as well. So well, we know that when it comes to the area of audit risk, it's a possibility that the auditor might not provide an appropriate opinion. Or on the other words, we can mention that audit risk is a possibility that the auditor might express an inappropriate opinion on the financial statements when the financial statements are materially misstated. FS misstated ആയിരിക്കുന്ന സമയത്ത് അതേ പറ്റിയിട്ട് തെറ്റായ ഒപ്പീനിയൻ കൊടുക്കാനുള്ള ചാൻസിനെയാണ് ഓഡിറ്റ് റിസ്ക് എന്ന് വിളിക്കുക. And as we know, there are three components of the audit risk. There will be inherent risk. In addition to which, they can also be having possibility of control risk and detection risk. So, when it comes to the inherent risk, before considering any related controls for the company, there's always a possibility that financial statements will be misstated, maybe due to multiple reasons. So that possibility of having a misstatement in the financial statements is known as inherent risk. Controls എല്ലാം കൺസിഡർ ചെയ്യുന്നതിന് മുന്നേ തന്നെ FS misstated ആവാനുള്ള ചാൻസ് ആണ് inherent risk എന്ന് വിളിക്കുക. Maybe consider that the client is adopting a accounting standard for the first time. They might not be familiar with it, so the possibility of mistake is high. Consider that a finance director, he's joining the company for the first time. He might not be familiar with the company's accounting policies and estimates. The company is having complex transactions, like companies having more than 100 countries operations. In that case, the company will be having significant amount of foreign currency transactions and the possibility of mistake is high. If the company has got more than 40 plus subsidiary, the possibility of mistake will be high. All this will be considered as inherent risk. And at the same time, every company should be maintaining adequate amount of internal controls to make sure that the company's internal controls are operating effectively. And if the company's controls are not operating effectively, the company's controls will not be able to prevent, detect, and correct the mistakes in the financial statements, due to which there will be possibility of having mistakes in the financial statements. That is something called control risk. അപ്പോൾ ഒരു കമ്പനിയുടെ ഇന്റേണൽ കൺട്രോൾസ് പ്രോപ്പർലി വർക്ക് ചെയ്യാത്തതുകൊണ്ട് വരുന്ന റിസ്കിനെയാണ് കൺട്രോൾ റിസ്ക് എന്ന് വിളിക്കുക. ഇനി there's always a possibility that even though the auditor performs the audit procedures appropriately, there are some cases where the auditor will not be able to detect the mistakes in the financial statements. FS-നകത്തുള്ള mistake ഓഡിറ്റർക്ക് കണ്ടുപിടിക്കാൻ പറ്റാണ്ട് വരിക. That is something called detection risk. So the only risk that arises from the part of the auditor will be the detection risk, and the inherent risk and control risk can together be called as the risk of material misstatement. The risk of material misstatement. So the inherent risk and control risk will be together called as risk of material misstatement, and audit risk will be the combination of risk of material misstatement and detection risk. The risk of material misstatement and detection risk will together give rise to audit risk. So when you get a question on the audit risk, you have to include all the risk, like inherent risk, control risk, and detection risk. But when you get a question on the risk of material misstatement, you are not required to mention anything in relation to detection risk. Instead, you have to focus only on the area of inherent risk and control risk. Then, either you might be getting a question on audit risk with accounting treatment, or there can also be chances that you might be getting a question on audit risk without accounting treatment. So consider that you have got a question on audit risk with accounting treatment. So whenever you get a question like that, first of all, you have to mention whether that is material or not. So you have to mention the materiality. You have to mention whether a risk is material or not. Secondly, you have to clearly mention about the actual accounting treatment that is required in that scenario. So the required accounting treatment have to be mentioned. Then there's a possibility of having risk in every accounting treatment. So what will go wrong? What can go wrong? So that will be the risk that have to be mentioned. So whenever you mention what will go wrong, to get the professional mark, you have to clearly mention about what is mentioned in the scenario plus what went wrong there. So the scenario plus accounting treatment have to be mixed up together, and then you have to express the impact over the company's financial statements. Impact over financial statements. Say, for example, consider that in the scenario, as we have already discussed in our revision and our regular session, I will mention the same example here as well. See, it's mentioned in the scenario that a company have signed contract with some of their customers, and under the contract, company have agreed to deliver product to customer's warehouse, and the final inspection of the products have to be done by the customers. But as the customers' warehouse are not yet complete, company have delivered the product to a third-party warehouse, and the goods are not yet inspected by the customers. But the company states that they have satisfied the performance obligation and they have recognized the revenue. This is what mentioned in the scenario. Okay. Let me ask you guys, which is the relevant accounting standard here?
Revenue.
Revenue recognition. It's IFRS 15, revenue recognition, right? So in that case, first of all, you have to mention whether the amount of contract with the customer, maybe 20 million. If it is 20 million, you have to first of all mention whether that amount is material or not. So you'll be mentioning like this: the amount of misstatement in relation to the contract is 20 million, and it is material to the financial statements as it constitutes 7% of profit and 5% of total asset. Then you need to mention the accounting treatment. As per IFRS 15, revenue from contracts with customers, the revenue should be recognized when the performance obligations are being satisfied. Then you have to mention what will go wrong. However, during the current year, the company have signed a contract with the customer, and under the contract, the company have agreed to the customer they will deliver the product to the customer warehouse, and final inspection of the goods have to be done by the customers. Therefore, the revenue should be recognized only when the performance obligations are being satisfied. However, the company have delivered the goods to third-party warehouse instead of delivering it to customer warehouse, and the goods are not yet inspected by the customers. But the company still claim that they have completed the performance obligation and they have recognized the revenue, which is inappropriate accounting treatment, which have resulted in overstated revenue and understated deferred income. This is what you need to mention as the audit risk there. Is that clear, everyone? Okay, so we have clearly included the things from the scenario directly to our answer. We have mixed up the accounting treatment along with the scenario. This is how you need to express what will go wrong in this situation. And again, when you mention about the accounting treatment, make sure one thing, that you are not required to excessively write the accounting treatment. At the same time, the required treatment should be there as well. Say, for example, well, we have studied about the 5-step model recognition for IFRS 15, right? First of all, we have to identify contracts with the customers. We have to determine the transaction price. Then we have to allocate the transaction price to the performance obligation on the basis of the standalone selling price. And finally, we need to recognize the revenue when the performance obligation in relation to that specific contract is satisfied. We have studied this 5-step model. Well, you are not required to explain the same 5-step model in the example which we mentioned just before. Instead, you are only required to mention about the basic treatment that is required for IFRS 15, as there is only one single performance obligation here. But on the other hand, if there is multiple obligation about which it is actually mentioned in the scenario, and you are only mentioning about a single performance obligation, then that won't be appropriate. So you have to read the scenario properly and write only those accounting treatment which the scenario demands. So properly stick on to the scenario. So this is how you need to explain each of the audit risk with accounting treatment. And as we have shown here, first of all, you need to determine the materiality. Well, there are some changes from the last September exam onwards. Now the examiner will demand you to calculate the materiality on a basis of specific benchmark. And for computing and explaining the benchmark on the basis of which you have calculated the materiality, you will be getting up to 3 marks for the materiality's computation and its justification. So basically, when it comes to the materiality benchmarks, well, we know that it can be determined either on the basis of SOFP element or on the SOPL elements or on the basis of the nature. Okay. So which are the SOFP elements? It can be
What
about the SOPL?
Revenue.
Profit. What else?
Gross profit.
Gross profit. Exactly. Revenue, profit, gross profit. Perfect. So when it comes to the statement of financial position, what was the benchmark? What's the lower limit and the upper limit?
1% to 2%.
1% to 2%. What about the net assets?
2
2
to
to
5%.
5%.
It's 2% to 5%. What about the revenue?
0.5 to 1.
0.5% to 1%. What about the profit?
5 to 10%.
5 to 10%.
Exactly, it's 5 to 10%. And again, what about the gross profit?
0.5 to
0.5 to
1.
1%. So it's very easy to remember. You only need to study the lower limit, and the twice of the lower limit will be the upper limit, with the only exception for net assets, because there only lower limit is 2% and upper limit is 5%. So the examiner will ask you to compute the materiality on the basis of a specific benchmark. However, they will never ask you to pick the lower or the upper limit. So that's your choice, and you need to give the justification for choosing lower or the upper limit. Basically, when it comes to the decision part, we need to consider certain benchmark to consider whether it have to be a lower limit or the upper limit. So first of all, we need to consider whether it's a new client or not. Then secondly, we need to consider whether it's a newly listed client. Then we need to consider whether there is any corporate governance weakness. Okay. Then next, we need to consider whether there is any internal control weakness. Then we need to consider whether there is any possibility of having management bias. So these are the main factors. Additionally, we can also consider whether there is any possibility of having high risk of material misstatement. And if any of these factors exist, especially you need to consider whether it's a new client or a newly listed client. If it's a new client or a newly listed client, always keep in mind, we need to go on with the lower limit. You need to choose 1%. In case if you're selecting materiality on the basis of total asset. However, consider that it's not a new client or a newly listed client. In that case, you may go on with the upper limit itself. And from the upper limit, you need to reduce it back down to the lower limit on the basis of the existence of other factors. But always keep one thing in mind. Our choice is not to take 1% or 2%. Instead, what you need to do is like, first of all, you need to consider the profit. Consider that the profit of the company is 10 lakh. Okay. That's 1 million is the amount of profit. So first, we need to determine the benchmark. So our benchmark will be 5% to 10%. So 5% of 100,000 will be, 1 million will be 50,000, and the upper limit will be 100,000. So the lower limit is 50,000 and the upper limit is 100,000. So our choice is not to choose whether 5% or 10%. Instead, we will be deciding on whether to choose 50,000 or 100,000. So suppose if it's a new client or a newly listed client, as I mentioned earlier, we will definitely be choosing the lower limit, 50,000 itself. But consider that it's not a new client or a newly listed client, then we will go on with 100,000. If there is corporate governance weakness, we'll reduce it back to 90,000. If there is high risk of material misstatement, reduce it to 80,000. If there is managerial bias, we'll reduce it down to 70,000. If there is any internal control weakness, we'll reduce it back to 65,000. Or we will set an average limit of 70 itself. So this is how we will be choosing the benchmark. So only in case of new client and newly listed client, you are not required to consider anything else. Instead, you can directly go on with the lower limit itself. Clear? Is that clear, everyone? Okay. Then, so this is how you need to choose the materiality. So these were the map. First of all, we need to consider the materiality. We'll be considering materiality on the basis of certain benchmark. To decide on whether to choose the lower or upper limit, we have to consider these factors. So this is not just for the audit risk. This format is common for audit risk as well as for the risk of material misstatements. Okay. Then there are also possibility where you might be getting a question on audit risk without accounting treatment. So when it comes to audit risk without accounting treatment, you're not required to calculate the materiality. Instead, you need to consider whether there is any mistake or possibility of mistake in the scenario. If there is anything like that, identify that, which means you need to explain the fact in the scenario. Then you need to explain why this gives rise to a risk. Then you need to mention about the overall impact on financial statements. Anyway, this will create an overall impact on FS. So you have to mention about overall impact on financial statements. So you have to identify the risk, explain it, and have to show the overall impact on the company's financial statements. This is what you need to do when you get a question on audit risk without accounting treatment. Okay. Consider that it may be mentioned in the scenario that there's a new finance director for the company, as the existing finance director has left the company due to a fraud or whatever the be the case. And it may be mentioned that the new finance director is from a pharmaceutical industry. Our company is operating in a banking sector. So this is what it's mentioned in the scenario. So in that case, you can explain the risk in your own words. You can mention that the company have appointed a new finance director who is having more than 10 years of experience in a pharmaceutical business. However, the client company is operating in a banking sector. The accounting policies and the estimates that will be applicable for a banking sector company will be entirely different from that of a pharmaceutical company. Therefore, there can be chances that the finance director might not be having adequate amount of experience in relation to the accounting treatment that need to be carried out for the client company. So the possibility of having financial statements, misstatements will be high. So this is how you will be explaining audit risk without accounting treatment. So this will be in general sense. So there won't be any specific accounting treatment. Instead, the possibility of mistake will be purely be evaluated on the basis of your judgment. So this is how you need to present answers for audit risk without accounting treatment. Clear, everyone?
Yes, sir.
Yeah. And I missed one thing. So, well, we need to consider materiality on the basis of SOFP, SOPL, and there's one more element here, nature, right? So when it comes to the nature, just keep it in mind. It can be anything, okay? Depends on the company. But commonly, you can consider two things as material. One thing which affects the company's ability to continue in going concern. If there is anything mentioned in the scenario that might affect a company's ability to continue as going concern, it will always be material on the basis of its nature. In addition to which, you can always consider the possibility of having any existence of related party transactions. If there is any related party transaction, that related party transactions will also be always be material on the basis of its nature. And when it comes to the related party transactions, we know that it can be a transaction with a parent company or with a subsidiary or with a joint venture or with an associate. It can also be the possibility of having transaction with a key management person, such as the top tier board members, or it can be a transaction with any of the company's directors. All this will be considered always material on the basis of its nature. So this is what we need to consider as material on the basis of the nature of the transaction. So we need to consider whether there is any factors which might affect the company's ability to continue as going concern, or if there is any factors that might affect the related party, then it will be treated as material. So this is what we need to consider the materiality on the basis of its nature of the transaction. Is that clear, everyone?
Yes, sir.
Okay. So this is what we need to consider with regarding the audit risk with accounting treatment and without accounting treatment. Then, next, most importantly, when you identify the risk, the examiner is asking you to identify the significant risk in the scenario. So when they ask for significant risk, you have to prioritize the whole set of risk on the basis of its significance. Therefore, make sure one thing, you should never write a risk directly after picking from the scenario. Instead, you have to do one thing. You have to read the whole question in a go. And while reading the question, pick up the key points or the identification part of each of the risk. Consider that if it is mentioned in the scenario that it's a new client, just copy the new client term and paste it in your answer sheet. Again, if it is mentioned that it's a newly appointed finance director, copy paste that. Company's first time adopting a standard, copy paste that. So you have to copy paste all the risk together while reading the question. And immediately after that, you have to prioritize this set of risk on the basis of its significance. And only after that, you should start with the answering part, because or else there can be chances that you might be picking some insignificant risk and explaining it, and you won't get any marks for that. In addition, you might also lose the professional marks, as professional marks is based on identifying and prioritizing significant risk. So these are the criteria for prioritizing significant risk. First of all, you can consider the possibility of having risk of fraud, which means if it is mentioned in the scenario where there is any possibility of managerial bias, consider that the company is going to take a loan for a significant amount of loan. So the management might be biased to overstate the company's assets and profit to get the loan amount. Or there can also be same possibility where if the company is planning to be listed in a foreign stock market or in their home jurisdiction itself, or if the company is planning to make any share issue, or if the company is planning to dispose of their shares. In all these situations, managerial bias will be high. Or if there is possibility of providing bonus based on revenue or any other sales targets or anything like that. Or if there is any recent economic, accounting or other developments, like a company is adopting standards for the first time. If there is something which affects the impairment of assets, anything like that can be significant. If it's a subjective area, like a judgmental area, significant amount of provision, significant amount of fair value of the asset, all this can be subjective areas. If there is unusual transaction, consider that the company is having an acquisition of a joint venture for the first time, so they are not familiar with the equity method of accounting. So in that case, possibility of mistake will be high. If there is any related party transaction, as we mentioned earlier, transaction with a parent, subsidiary, joint venture, or anything like that, or if the complexity of the transactions are very high, like if the company have got more than 40 subsidiaries, if the company is dealing with the financial instruments for the first time, if the complex treatments are there, it can also be significant. So on the basis of these factors, we need to first of all, identify the risk, and we have to sort it on the basis of its significance. The most significant risk should be provided first, and from there to the lower. So you have to do it like that. Then only we'll be getting professional marks as well as normal marks. Okay. So what are the factors we need to consider while determining the significance? We need to consider whether there is any possibility of fraud, recent economic, accounting, or other developments. Is there any subjective areas? Is there any unusual transaction? We have to consider the significance of the related party transactions, and we need to consider whether there is any complex treatment. All this will be material on the basis of its nature as well. So we will be considering all this as significant risk. Is that clear, everyone?
Yes, sir.
Okay. So I will be sharing you a note as well as some set of notes for the AAA. So these notes are directly available in Google as well. So you can search for the same note along with my name in Google. You will be getting the same file. Like there's a file called Audit Risk, which I have already shared. So in this Audit Risk notes, I have listed down almost all the possible risk and response. Sorry, not responses, but all the possible risk. But this is not anything specific to the question, but these are based on some of the general points which were there in our past question papers. Like if there is a new listed client, there can be chances of having managerial bias and lack of knowledge of listing requirements, new client, appointment of new directors, lack of finance director. If the company lacks an audit committee, what will happen? If there is control risk, if there is a product recall, what will be the accounting treatment and related risk in case of there is a payment in advance for the bespoke inventory. So I will be sharing you this file. And in addition, you can also download it directly from the Google as well. So please do go through this file. It's a 17-page file whereby I have included all the possible normal set of risk as well as its related explanations. And I've also included group-based risk as well. Either you'll be getting individual financial statements, or you might also be getting consolidated financial statements for your exam, whereby you will be responsible for a group audit. So you can consider all those risks together. Like say, for example, in normal group-based question, usually used to find either the acquisition of a subsidiary or an associate, or the disposal of a subsidiary or an associate. So we have included all the possible risk in relation to the disposal and the acquisition of a subsidiary, as well as relating to the acquisition and disposal of associate as well. And we have also listed down the treatment required for a joint venture also. So you may please go through this point. And if anyone have already gone through this point, please do revise it again and again. Okay. And you need to, you don't need to focus much on this note. This will give you a clear picture on what the risk will appear for the exam. But in addition to this, you need to focus much more on the accounting standards. As I always used to mention, you have to give maximum importance for the accounting standards, because only if you have got a clear picture on the accounting treatment, you will be able to cope up with any new risk that may be appearing in your exam. Or even if you have gone multiple times through your whole syllabus, and if you're still not having a clear picture on accounting standard, you won't be able to present any answers properly for the exam. So please make sure that you've got a clear picture on the accounting treatments that are actually required. So please make sure that and have a proper knowledge on that. And then you start with the question practice area. Okay. So this is what you need to consider with regarding the area of audit risk as well as risk of material misstatement. So next, our core area is the area of business risk. So basically, when it comes to the, sorry?
Like important standards I don't know. Like
See, if it was in the prior exams, normally you used to get some specific questions. Like normally we used to have questions from the area of IFRS 15, IAS 16. Then recurringly we used to get questions from IAS 37, 38, 36, IAS 40, IAS 21, IAS 24, IAS 10, IFRS 15, IFRS 8, IFRS 3. These were the usually tested standards. But now you can get question from any standard. Okay. Because in the past exams also, even there were questions from the area of IAS 41 relating to biological assets and all. So definitely, even we have practiced the same question, right? So definitely there can be chances of having questions from all these areas. So definitely we have to learn all these standards properly.
okay.
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 Yeah. So, Rayhan, when it comes to ISA standards, it's not that important to go through the ISAs, not that important, but still you have to have a good picture on the standards relating to reporting part. Okay, that's the most important one, because only if you have got a clear picture on the reporting standards, especially reporting standards relating to going concern. I believe you might be familiar with the types of opinion and all, but still have to focus on the going concern reporting standard. That's the important one. Other than that, just give more importance for the accounting standards rather than for the auditing standards. Okay. All right. So next, it's the most important core area of our syllabus. That's the area of business risk. So probably we can expect a question from the area of business risk as well, but it's not 100% sure like risk of material misstatement and audit risk. You can expect a question. But well, we know that when it comes to the area of business risk, these are not based on any specific standards or any specific theoretical area, but it's purely judgmental. So every business will be having their own objectives. However, there will be some sort of issues or maybe actions or inactions, or there may be some changes in the market which can affect the company's ability to achieve these objectives or execute their company's strategy. And this will be considered as business risk. So business risk is a risk of inability of a company to meet their objectives or execute their strategy. അപ്പോൾ ഒരു കമ്പനിയുടെ ഒബ്ജക്റ്റീവ് എന്താണോ അത് മീറ്റ് ചെയ്യാൻ പറ്റാത്തതിനെ അല്ലെ സ്ട്രാറ്റജി എക്സിക്യൂട്ട് ചെയ്യാൻ പറ്റാതിരിക്കാനുള്ള സാഹചര്യത്തിനെയാണ് ബിസിനസ് റിസ്ക് എന്ന് പറയുക. Again, it's a risk. So it's just a mere chance. Doesn't mean that anyway the company will be having difficulty in its trading situation. It's just a risk. So there are basically three components for the business risk as well. It can be a financial risk, operational risk, or compliance risk. But this classification is not required for our exam. We will be considering our judgment for the purpose of evaluating the business risk. So consider that if a company is having any sort of financial inability, like say, for example, if the company is not able to settle their suppliers or their creditors on time, if the company is not having proper cash flows, company is having operating losses, negative operating cash flows, if the company is not able to meet their financial requirements, like if they are not able to raise a capital through bank loan or through the issue of shares, there is significant downfall in the amount of share capital value, market value of shares. Or if the company's customers are not paying on time, if there is significant reduction in the amount of revenue, all these are the financial difficulties. When it comes to the operational difficulties or operating difficulties, companies not having proper raw materials or companies not getting labor on time. There are product failures or there are mission breakdowns. There are some sort of employee issues, high employee turnover. All this will give rise to operational risk. And the third one is compliance risk. Companies having significant amount of penalties and fines. So going concern uncertainty due to non-compliance with law and regulation. That will be the compliance risk. So all this together will be called as business risk. So when you get a question from the area of business risk, let it be anything from the scenario. First of all, you need to identify the business risk from the scenario. So you need to clearly identify it, which means you need to mention the fact. Then you need to explain why this particular situation will give rise to a business risk. Finally, you need to show the impact of the risk. So you need to mention about what will be the impact of this risk. But instead of mentioning about the impact of this risk on financial statements, we will be mentioning about this impact on risk on company's profit or on the company's margin. Plus, we need to show the impact that will be created over the revenue or on the company's reputation. Then on the company's brand name. And most importantly, on the company's cash flows. Okay. This will be the type of impact that we will be expressing. Clear? So instead of showing the impact on the company's financial statements, we need to mention the impact of profit or margin, revenue, reputation, brand name, cash flows, etc. So this is how we need to mention the business risk. So when it comes to the area of business risk, I will be sharing you a file relating to the business risk as well. Again and again, I'm telling you the same thing. This is also from the past question papers. I've just summarized all the points which were available in the past question papers. And these are the risks we have sorted out. So consider that if it is mentioned in the scenario that company is having an international operation. So if it is a term that the company is having international operation, or if it's a multinational company, we can explain multiple risks. First thing, there can be chances that company might not be complying with the law and regulation, which might invite penalty and fine for the company. Same as that, you can mention that when a company is having international operation, there can be possibility of having political instability in the country in which the company operates, which might give rise to difficulty in planning the company's activities. Then again, you can mention risk in relation to foreign currencies. The company is having a volatile cash flows and the company's profit will also be volatile. You can express that. When a company is relying only on a single supplier, if it is mentioned like that in the scenario, you can mention that if the company is having only a single supplier, if there is any delay in supply, then there will be disruption in the company's operation. Company's product will be stocked out as well as the company's production process will be halted. If there is a regulatory issue, if the company complies with this law and regulation, there can be chances of having significant capital expenditure. Therefore, the company might be facing cash flow difficulty. Or if the company is not complying with the law and regulation, there can be chances that there will be penalty, fine, and bad publicity for the company. If there are some issues relating to the environmental damage, there can be chances that the company might be facing reputational damage as well as company's cash flow and revenue will be affected if the customers have canceled the contracts with the company as the company has become a violator for law and regulation. If the company is diversifying their operation and entering into a new market, or if the company is growing rapidly, again, there can be chances of having risk that company might not be able to focus on their existing activities appropriately. Thereby, there can be chances that their existing operations might be affected. In addition, when a company is going for a rapid growth through investment, company is having significant amount of cash outflow, which might create cash flow difficulty for the company. So these will be the sort of business risk which we need to explain in relation to the scenario. Is that clear, everyone?
Yes, sir.
Okay. So business risk will be the possibility of having a company's inability to achieve their objectives. So you need to consider all those factors which might lead to the lack of achieving objectives for the company. Okay. So these were the core areas of the risk. So we have discussed on audit risk, risk of material misstatements, and business risk. In addition to this area, well, we are gonna discuss on the area of audit procedures. So, well, we know that when it comes to the area of audit procedures is the core area of our syllabus. Well, we need to consider audit procedures both for the 25 marks question as well as for the 50 marks question. So when it comes to the area of audit procedures, whenever you write a audit procedure, you should be clearly including a procedure first. So basically, when it comes to the procedure part, it can be anything. So it can be inquiry, inspection, observation, recalculation, reperformance, analytical procedures. Same as that, it can be observe, inspect, assess, compare, consider, any terms like that. It should be professional terms. You should never include a point like ask the management. Instead, you should always be referring inquire the management or discuss with the management. You should never include the point read the financials. Instead, you should use the term review the financial or inspect the financial statements or examine the financial statements. So these are the audit procedures or the procedure term that you can use for the exam. Agree, analyze, ascertain, assess, compare, consider, inquire, ensure, examine, monitor, observe, obtain, calculate, reconcile, reperform, review, scrutinize, verify, vouch. Any of these points can be used for the exam. Plus, you have to give a document or information that is actually required. Plus, you have to mention the purpose for which you are performing this procedure. So when you get a scenario, okay, so when you've got a scenario, consider that you've got a scenario. Just a moment. Okay. Yeah, consider that you've got a scenario like this. At the planning meeting, finance director of dashing company informed the audit engagement partner that company is closing one of the small production site. As a result, number of employees would be made redundant. The redundancy provision of 110,000 is included in the draft financial statements. So it is mentioned in the question that company is planning to close down one of their small production site. So the company's employees might lose their job, due to which the company have to pay compensation for the redundancy, and they have created a redundancy provision of 110,000. So if we got this particular information from the scenario and they are asking us to write the audit procedures in relation to the redundancy provision, then in that case, or let it be any case, when you are required to provide an audit procedure, first of all, you have to think about the purpose of the procedure. So, well, here we need to confirm whether the amount of redundancy provision is 110,000. So we need to consider whether the redundancy is actually 110,000 itself. Then next we need to consider about the rationale on the basis of which this particular client have determined the provision as 110,000. Then we need to know whether there will be a probable future cash outflow, as the provision need to be created only if there is a probable cash outflow. Then we need to consider whether there will be a present obligation, which gives the rise to this provision. So, well, we know that in case of redundancy, a provision have to be created only if there is a present obligation, not just for redundancy, for every provision. But in case of redundancy, this provision should be created only if the company have informed about the redundancy to employees, or only if the company have actively started their redundancy program. And in addition to which, disclosures of the provision should also be provided in the company's financial statements. So we have to confirm whether all of this exists. Then only we are required to create the provision, and the amount of provision should be appropriate to be included in the financials. So in this case, we will just do one thing. We will be considering the procedure. Yeah, we'll be considering the procedure. We will be using almost 10 points to give answers for almost every question. Whenever you get a scenario, and whenever you've got some set of purpose for the purpose of, purpose of performing audit procedures, you should always think about what I can inquire or discuss with the management in this case. So in this case, what we can do, inquire with the management or discuss with the management about whether they have made the announcement of redundancy to the employees. in order to consider whether there's a present obligation for the company. If we need to have a written documentation in anything, then we can obtain written representation from the management. So obtain written representation from the management about the rationale on the basis of which redundancy provision of 110,000 is recognized to ensure whether it is reasonable. So obtain written representation from the management about the rationale on the basis of which the redundancy provision of 110,000 is recognized. Everyone will provide till there, but that answer is incorrect because the student have not included the purpose there. So to ensure whether the amount of provision is reasonable. So now the answer is complete. So this is how you need to give the procedure. There should be procedure, document or information, and purpose. Then next one, you have to think from whom you will be able to obtain external confirmation. Who will be the third party here? So in case of a provision or in case of a redundancy compensation, well, we know that an advocate or solicitor will be the third party. So obtain external confirmation from the lawyer or solicitor to confirm whether there will be a probable future cash outflow for the company as a result of the redundancy. There also we have included to confirm, to assess, to consider, to understand, to ensure. So this should be there as purpose. Then correspondence means it's a communication between two parties. So by looking at a communication that is done between client and a third party, we'll be able to understand something. So here, who will be the third party? It can either be, normally the employees will not be considered as third party, but in this case, we can review the correspondence between the company and their employees in order to confirm whether they have made the announcement of redundancy to the employees, which creates a present obligation. Or we can obtain we can review the correspondence between the company, the Allen company and the company lawyer in order to consider whether there will be a probable future cash outflow for the company. Then, whenever there is a calculation, you can always mention the possibility of having recalculation. Here you can recalculate the amount of redundancy provision of 110,000 for dashing company in order to confirm the mathematical accuracy. I believe you have properly, specifically understood the importance of including data from the scenario to the procedure. Recalculate the redundancy provision of 110,000 for Allen company in order to confirm mathematical accuracy. We have included the name of the provision. We have included the figure. We have included the name of the client. So all this have to be included within the procedure. It should be specific to the scenario. Instead, you should not include recalculate the provision to confirm mathematical accuracy. This is what we usually used to done in AA, for which we never used to get any marks as well. So make sure that you're including the name of the client, amount, as well as the specific details which are provided in the question. Then you can always consider the possibility of having analytical procedures, which is comparison between two balances. So before comparing with the balance, you have to properly think on what balance you will be able to compare this particular information. Either you might be comparing the current year data with that of the previous year, or you can also consider comparing the current year data with that of the budget or the industry average. So in this case, will you be able to compare the current year data, that is the amount of provision for the current year with that of the prior year? Definitely not, because redundancy provision was not there for the prior year. It's an amount that is there only for the current year. So in that case, you will not be able to compare this with the prior year, but you can compare it with the industry data. And in case of any significant difference, you can discuss with the management about the reasons for the same. So you can perform analytical procedure by comparing the redundancy provision of 110,000 with the industry data. And in case of significant variance, discuss with the management for the same. The next one. Normally, you will be getting financial statements as part of every question, especially when it comes to a 50 marks question. So consider that the company have provided revenue, cost of sales, gross profit, operating expenses, profit before tax, tax, profit after tax. So if the company have included the amount of expenses relating to the redundancy provision, definitely that will be within the operating expenses. So to understand whether the company have actually expensed the amount of provision, what you can do, obtain the breakdown of operating expense in order to confirm that the expenses in relation to redundancy provision of 110,000 have been included in the statement of P&L. So whenever you need to know, say for example, you need to know whether the amount of impairment, amortization, depreciation, or any other amounts, maybe finance costs, consider that the company have taken a new loan, in the other case, then we can obtain the breakdown of finance cost in order to confirm that the expenses in relation to that, interest expense in relation to the new loan have been included in the statement of P&L. Considering that way. Whenever a company's directors have conducted a board meeting, well, we know that for every affairs relating to the company, every company should host a board meeting. And whenever a company hosts a board meeting, every decisions that have been taken during the board meeting will be included within the board minutes. So you will be able to review the board minutes in order to understand that. So, well, you need to know whether the company have actively started the redundancy, or well, if you need to know whether the company has announced the redundancy to understand whether there is a present obligation, you can review the board minutes. Or in case, if there is any specific expense or income for the company, you can agree to the supporting documents. But you should never ever merely mention that agree sales to supporting documents. Instead, you have to mention that to supporting documents such as sales invoice and goods dispatch notes or sales order. So that name of the document have to be clearly provided. Finally, as we usually used to do in our AA exams as well, we need to always consider the possibility of providing notes to financial statements. We can review the notes to financial statements to confirm disclosures in relation to dash are complete. Here in relation to redundancy provision are complete and are in accordance with IAS 37 provision contingent liabilities and contingent assets. So these are the procedures which you can use in almost all the cases. Well, we have taken some or much time for the discussion of this part. It is especially for the purpose of its importance. Especially this particular area will appear for the 25 marks question as well. And this will be the same thing that we can use for the audit evidence as well. So this is one of the most important area. So do make sure that you are providing adequate time for this particular session. That's the area of audit procedures. Especially if any students are there who have taken exemption for the AA exam, you should make sure that you have got a clear picture on the area of audit procedures, because it's damn important. Anyway, you will be getting a 5-mark question, at least a 5-mark question in the 50 marks, out of 50 marks for the procedure. And in addition to which, it might be asked as part of your key performance indicators procedure, I mean the KPI. Then there can be chances of having questions in relation to the forensic audit, or in relation to due diligence engagement, or in relation to the PFI engagements. We will be learning specific points. It's a bit different. So the other areas it can be tested. So do make sure that you've got a clear picture. So whenever you got a question, I mean a scenario, you need to give these questions to the scenario. So what I can discuss with the management, is there anything about which I can obtain an external confirmation? Or is there anything about which I can obtain a written representation from the management? Is there any third parties with whom the company have communicated, and is there any possibility of having reviewing a correspondence? Is there any computation which I can recalculate? Is there any data which I can compare with the prior year or with the industry standard? Is there any expenses breakdown which I can take to confirm whether any expense have been included within that head? Is there anything that the board have discussed during the board meetings? Is there any particular expense that I can match to the supporting documents? Or if there is something on which I can mention in the notes to financial statements that need to be reviewed as part of the audit. So you need to make sure these things. Is that clear, everyone?
Yes,
is that
sir.
clear?
Yes, sir. Yes,
Yeah.
sir.
Alan, it is not required to mention the same assertion actually. The meaning of the assertion is required to be provided, but it doesn't mean that you're actually required to provide the same name of the assertion or anything. Like it is not required to mention that review a sample of year-end trade payables in order to confirm the cutoff. Instead, you're only required to mention that to confirm whether the transactions have been included within the correct accounting period. So you can do that. Okay. Same as that, it should be specifically to the scenario rather than to the assertion. So basically, when it comes to substantive procedures, we will be focusing much on name of the assertion of the purpose. But here they are not asking us for the substantive procedures. Instead, they are asking us for audit procedures, right? So when it comes to audit procedures, it's a combination of test of control, substantive procedures, and risk assessment procedures. And within the substantive procedure itself, you can consider substantive analytical procedures, which are comparisons, like compare the current year allowance for receivables as a percentage of receivables with the previous year and the industry standard. That's a substantive analytical procedures. As well as you can consider substantive test of details as well. This is what we consider substantive test of details, discussing with management, obtaining representation, external confirmation, so on and so. So any of this can be included. So this is not specifically substantive procedure. Instead, in AAA, we are giving emphasis on audit procedures. Okay. Yeah, definitely you can include these points as bullet points because they are asking us to provide the substantive procedures which you can perform. So you can list down the procedures that you need to provide. So basically, you will be getting 1 mark per procedure. So if it's a 5-mark question, include 5 points. Okay. Is that clear, everyone? Paka?
Yes, sir.
Yeah. And finally, and most importantly, among the 50-mark question, it's the area of ethics. Ethics is the core area of our syllabus. Because ethics will be there for the 50 marks area as well as for the 25 marks area. So basically, when it comes to the ethical side, first of all, we have to have a clear picture on the fundamental ethical principle or code of ethics. So basically, when it comes to fundamental ethical principle, there are 5 ethical code of conduct that every company should be focusing on. Every audit firm should be focusing on. Integrity, objectivity, confidentiality, professional competence and due care, professional behavior. When it comes to integrity, every auditor have to be straightforward and honest in every dealing with the client company. When it comes to objectivity, you should not be biased or you should not be having any conflict of interest. You should always be working by looking at the objective of the auditor. When it comes to confidentiality, you should always make sure 2 things. You should not disclose any information in relation to a client to a third party, unless there's a legal or professional duty or there is approval from the client. Secondly, you should never use an information obtained from the client for any other purpose other than the purpose for which you have obtained it. എന്തിനു വേണ്ടിയിട്ടാണോ വാങ്ങിയത് അതല്ലാതെ വേറെ ഒന്നിനു വേണ്ടിയിട്ട് അത് യൂസ് ചെയ്യാൻ പാടില്ല. When it comes to professional competence and due care, you should always keep on updating your knowledge. Whenever you provide a professional service, you should be providing that service with the most recently available standards. In addition to which, whenever you get a work from a client, you should accept the work only if you're having a proper understanding about the requirements as well as if you are having adequate competence. Finally, professional behavior, which means that you should always be acting like a professional. You should not do any act that may discredit ACC as a professional body or accounting professions as a whole. Accounting professionals as a whole. That is something called fundamental ethical principle. Normally, the examiner will be asking you by providing a scenario on to identify the ethical and professional issues. Any matters that act against these rules will be considered as a professional issue. Say, for example, if it is mentioned in the scenario that the audit partner's brother is working with the client company and the brother have conducted a fraud in relation to the payroll, and one of the junior auditor have reported this to the audit senior, and the audit senior have mentioned to the audit junior that he is the audit partner's brother, therefore we are not required to take any action in relation to this, and he have just asked him to wipe off the evidences in relation to the fraud. So in this case, they are acting against the integrity because they are not straightforward and honest, and at the same time they are giving importance for their personal benefit rather than professional benefit. So that will be against the objectivity. Every ethical threat will be against the objectivity. Consider that the auditor is suggesting a wrong accounting treatment, or if the auditor is mentioning to the juniors that the auditor is not required to collect sufficient appropriate evidence. Instead, they are only required to obtain written representation from the management to treat it as a conclusive evidence. We have already learned that written representation can only be used as support to other audit evidence, and it can never be used as an audit evidence. So it can never be used as sufficient appropriate evidence, to be precise. So in that case, if they are using it as a conclusive evidence, it is inappropriate and it is due to the lack of knowledge for the auditor. So that will be a professional issue. Okay, because it's against the professional competence and due care, he is not having adequate knowledge. If the auditor is auditing multiple entities in the same market, there are chances that some information relating to the client might be provided to the other client. So it's against the confidentiality. If the auditor markets his service in such a way that discredit other professionals or ACC as a whole, it's against the professional behavior. So these is how the professional issues will appear during the course of your exam. However, on the other hand, when it comes to the ethical threats, there are 5 ethical threats: self-interest, self-review, advocacy, familiarity, intimidation. When it comes to self-interest, you are giving personal importance rather than the professional importance. So if you're doing something considering your own personal interest, it will be against the self-interest threat. Consider that you're getting a gift or a hospitality, there's a family or personal relationship. Like, consider that my wife is working with a client company as a director. So I will never be able or willing to mention that my wife have done a fraud. So definitely that might affect my brand as well, or might affect my reputation as well. So in that case, I won't be able to do that. So that will be self-interest rate. Consider that there's a loan or guarantee. I might be having a fear that client might ask me to pay back the whole amount of loan if I report against them. So that will be a self-interest rate. If there is overdue fees, I might be always having a concern that if there is an overdue fees, definitely there's possibility that the client might ask you to reduce the quality of the audit to save the amount of audit fee. So that will be an issue. Or if there is any overdue fee, I might be always having a fear that if I provide a inappropriate or unfavorable opinion for the client might not be willing to pay the new audit fee as well as the prior year's audit fee. So I might provide a favorable opinion to recover both the fees. So in case of percentage or contingent fees, we have studied that when we get a percentage or contingent fees, even if the amount of profit is misstated, if the fees is based on profit, we'll never be willing to correct that. Because if we correct the amount of mistake, definitely the audit fees also will be reduced. If there is high percentage fees, likewise, if you're getting more than 15% of our total revenue from a single client for the 2 consecutive years, we might be willing to do anything in favor of that client. Lowballing, if the client have reduced the audit fees, or if we have provided a low quote for the audit fee, proportionally, we might also reduce the quality of the audit. That will be against the lowballing. If we have recruited a person to the client company as an employee, like if we have appointed the accounting staff for the client, then definitely we won't be willing to mention that the staff which we have appointed is not actively working. Or if he have done a fraud or mistake, we will not be willing to mention that to the client because that might affect our credibility as well. If we have got a financial interest in the client, or if we have got a close business relation, if we have got an employment with the assurance client, if we are having a partner on the client board, in all these situations, the same risk that they will be self-interested. Clear? Yeah. And we have to provide safeguard for each of these threats. Like if there is any family or personal relationship for a particular person in the audit team, we have to remove him out of the team. If there is any gift or hospitality, we have to reject it. We have to politely decline. If there is loan or guarantee, we should be obtaining an external review of the work done. If there is overdue fee, as per ACC's rule book, we are not allowed to continue an engagement without settling the prior year audit fee. If there is percentage or contingent fee, only one solution, that fee should be a fixed amount or it should be an hourly rate. I mean, the hours spent by the each auditors on the basis of which we can charge fees. If there is high audit fee, then we need to obtain external review of the work done. Lowballing is not allowed. Recruitment should not be done, should be politely declined. If we have got a financial interest, we should dispose of the interest in the financial side immediately. Like if we've got a share investment, if you want to join as the auditor, you have to dispose of all the interest in shares immediately. close business relationship, employment with assurance claim, partner on client, but whoever who creates the issue should be removed or should be considered as an external review of the work done. Have to be considered as safeguards. So when it comes to self-review thread, it's very much more easier to understand. If we have provided a financial reporting related service to a client, and if we are responsible for the audit of same client, that will be a self-review thread, as we will never be willing to mention that we have done a mistake relating to the work we have already undertaken. So whenever you get a self-review thread, consider that whether it's a thread which is already taken place. If any of the audit team members have already provided a service to the client, we should remove that individual from the team. Or consider that if the client is requesting the audit firm for a new service, in that case, you need to consider whether it's a new client or whether it's a listed client or a non-listed client. If it's a listed client, you should politely decline that. As per the rule book, you are not allowed to provide any service to a newly listed client or a listed client at least. You're not allowed to provide any service. However, on the other hand, if it's a non-listed client, you can provide them service by using separate engagement teams. Okay. Then advocacy thread. The client is asking you to represent the client company at a point. If the client asks you to represent the client company, in that case, definitely you are not allowed to do that. Okay. Then familiarity thread. Consider that if there is something that shows a close relationship between the auditor and the client, that's a familiarity thread. If the client company is having a long-term relationship with the auditor, like the auditor have provided almost 9 years of audit for the client, there is always a possibility that auditor might act in favor of the client company. It will give rise to familiarity thread. Or if the auditor is having any type of close business relationship, or if the auditor have worked with the client company before as an employee, in all this situation, familiarity will arise. And in those cases, we can remove that individual from the team. And in case of partner, we need to rotate him. Intimidation threat will arise in 3 cases: coercion, undue influence, creating limitation in the scope of audit. Coercion means threatening. Auditor is being threatened by the client company. Client company is telling to the auditor that the auditor, if the auditor have not provided a favorable opinion for the client, then the client will not be willing to provide audit service for the auditor in the upcoming year. Or if the client mentions that if the auditor has not provided them with an incorrect opinion, not provided them with a favorable opinion, auditor might not be provided with the audit fees outstanding, or the auditor is being charged with the litigation, or in any of the circumstances where the auditor is being threatened, can be treated as intimidation threat. Or consider that if there is someone in the client company who will be able to influence the audit team. Say, for example, the earlier partner who works with the audit team is now the CEO of the client company. So definitely that person who was working in the client company as a partner will be having influence over the audit team members. So in that case, intimidation will arise. And finally, the possibility of having any limitation in the scope of the audit engagement, like the auditor is not provided with sufficient time to perform the audit, like they are only providing 2 weeks of time or 1 month of time. Or if the auditor is not provided with access to all information, additional information, auditor is not being allowed to attend the inventory count or to communicate with the client's finance director or any finance team members, all this will give rise to intimidation threat. And in case of intimidation threat, you can communicate this matter with the audit committee. You can ask them to avoid whatever be the threat. Accordingly, you can mention. And in case if they are not appropriately taking any reasonable action, you must consider resigning from the audit engagement. So that's a case of intimidation threat. And when it comes to the management threat, so basically management threat is nothing but, consider that when it comes to the going concern, well, we know that it's the responsibility of the auditor to undertake, it's the responsibility of the management to undertake the going concern evaluation. Auditor is not required to carry out the going concern assumption of the company. It is the responsibility of the management. But unfortunately, the auditor is assuming the going concern responsibility as part of the audit firm's responsibility. So it will give rise to management threat, because it's actually responsibility of the management to undertake going concern evaluation, and auditor is only required to review the assumptions on the basis of which it is done and to consider whether it is reasonable. So if the auditor assumes management's responsibility as part of audit firm's responsibility, This will give rise to management threat. Then these are the safeguards, general safeguards that you can discuss with the management. You can remove the particular individual from the team. You can obtain external review of the work done. You can rotate the person in case of familiarity, or you can use separate teams, maintain professional skepticism, and so on. And most importantly, it may be mentioned in the scenario that as an auditor, you will be responsible for the client company's audit, as well as you are responsible for the audit of a competitor entity in the same market, or you are responsible for the entity that trade with each other. Like if you are responsible for the audit of Samsung and Apple, or if you are considering the audit of Apple and Intel, these are the companies that trade with each other and compete each other. So there will be threats to objectivity and confidentiality. And in that case, the first and foremost safeguard which you need to take is the client's permission. You need to obtain permission from both the clients with which you are planning to operate. So if you've got permission from both the client, then you can continue with the engagement. If not, you should drop one of the assignment. And not only by taking this particular safeguard, you will be able to continue with the engagement. Instead, you have to consider this additional safeguard as well. You should be using separate team for the Samsung and for the Apple. There should be procedures to prevent access to information. Any team member of the Samsung engagement should not be able to access the data of Apple. Then every team member should sign confidentiality agreement. So if anyone breaches that, they will be liable for the amount of loss for the client. There should be a senior who should be regularly reviewing the controls which already mentioned, or the safeguards which we mentioned. Senior should be thoroughly reviewing this. And there should be an advice that provided to the client in relation to how we will maintain the independence, because they will be concerned. So these are the additional safeguards which we need to take. Have to go through these notes. I will show you this. And if any additional safeguards cannot be taken by the auditor, you should decline the engagement or resign from the engagement. And for the engagement partner, engagement quality control reviewer, and for the key audit partners, as we mentioned earlier, the maximum amount of period which you can continue with an engagement will be 7 years. And as a cooling off period, you have to take 5 years in case of engagement partner, which means consider that from 2000 to 2007, you were the auditor of a client company. So from 2007 to next 2012 or 13, that's for the next 5 years, you are not allowed to associate with this client company in any manner, which means we will consider that by creating a gap of 5 years, that familiarity will be reduced. Then again, you can continue for the next 7 years. There's no issues. So the engagement partner's cooling off period will be 5 years. Engagement quality control reviewers cooling off period will be 3 years. And the key audit partner's cooling off period will be 2 years. So in this manner, we will be considering the cooling off period. So we have to consider the cooling off period of maximum up to 7 years. And after that, we will be having, the period served will be 7 years, and the cooling off period will only differ. That is 5, 3, and 2. Consider that they have performed multiple roles. So if the auditor have taken multiple roles, in these cases, the second role, that's key audit partner, engagement quality control reviewer, in all this situation, wherever there is a engagement partner's role, it will be maximum for a period of 4 years. 4 to 7 years that you can continuously work. Cooling off period will be 5 years. And in case wherever there are engagement quality control reviewer, the cooling off period will be 3 years. Okay, 3 years to a max. So this is how the cooling off period will appear. So this is what we have already learned with regarding the area of ethics. We have done multiple sessions on this area and practiced multiple questions. And I've asked you to go through a notes on the ethical threat and safeguards as well. So this will be the notes I will be sharing you on ethical threats and safeguards. Well, all these notes are publicly available, and if you want to share with anyone, you can do that. So they will also be benefited with this. So well, this is also based on the prior question papers only. So we have just compiled these notes, and we haven't included any specific points based on our judgments. We have compiled these notes on the basis of the guidance of the ACCS examiners. So in these notes, we have literally included all the possible ethical threats and related safeguards. The safeguards are provided in italics. So whenever you give answer for an ethical threat, you should make sure that you have to identify the threat. You have to mention that the client company have requested the auditor to provide a tax service. So this will give rise to self-review threat. then you need to explain how it gives rise to self-review threat. You can explain that after performing the computation for the tax-related service for the current year, this will be affecting the client's financial reporting. And in the upcoming year's audit, the auditor will be responsible for reviewing the tax-related treatment, and the auditor will not be able to give an unfavorable opinion if there is any mistakes in relation to the tax computation that the auditor have already undertaken, because it might affect the auditor's credibility. So auditor might intentionally try to hide the mistakes in relation to the scenario, which gives rise to ethical threats. And as a safeguard, auditor should communicate the matter with the client company's audit committee and should inform them that they will not be able to undertake this engagement as it is against ACCA Code of Ethics and Conduct. So this is what you need to give us the answer. So whenever you give a ethical threat, you have to clearly identify the ethical threat, explain it, and then you need to give the related safeguard as well. So identify the threat, explain it, and give the safeguard. This is what you need to do there. Is that clear, everyone? Is that clear?
Yes, sir.
Okay. So please go through these notes, okay? I believe you might have already gone through this, but if not, please go through this. This will definitely help you. Because ultimately, anyway, you will be able to write the answer for your exam with these notes itself. It's not because of the quality of notes and all, but ultimately, you know that anyway, the threat will be limited to 5. Either it will be an ethical threat on self-interest or self-review, advocacy, familiarity, or intimidation. So anyway, you will be able to bring down any set of points down to this 5 list. But the only knowledge which you need is to have a proper understanding on the ethical threat. So just make sure one thing, that there's a connection, you're familiar with the connection between these threats. So basically the self-review threat and intimidation threat, self-review and advocacy is very easy to be identified from the scenario. Because if there is anything mentioned in the scenario that might give rise to reviewing our own work, only if we have provided a work in relation to the financial reporting, there will be self-review threat. Only if we have represented the client company at a point, there will be advocacy threat. However, if there is a family or personal relationship, it can give rise to either self-interest threat, familiarity, or intimidation. But make sure one thing, that if there is only a threatening element, or if there is only an undue influence by that family member or the person with authority, then it will give rise to intimidation. If it is just because of mere familiarity between two persons, consider that if it is mentioned in the scenario that the audit client's CEO have requested the auditor to attend a party together. In that case, it will affect the independence of the auditor. That will be giving rise to familiarity threat. Self-interest threat will arise only if the auditor is also considering his own personal benefit. Consider that if I consider my wife, who is working with the client company, is an element which creates a reputational damage for myself, I would definitely hide the mistakes that the company have actually reported in its financials. So that's a self-interest threat. Or on the other hand, if there is nothing that affects me personally, and still I am giving a flexibility in my opinion because of the familiarity between me and other person, it will be a familiarity threat. So this is how we need to classify the threat between, or differentiate the threat between familiarity, self-interest, and intimidation. Is that clear, everyone? Okay. Yeah. Okay. So next one, it's with regarding the analytical procedures. See, basically when it comes to our 50-mark question, we will be getting a question on audit risk with analytical procedures. So when we get a question on the basis of audit risk with the analytical procedures, you have to make sure something, that first of all, you need to calculate some set of ratios. And you have to make changes, some set of changes in the way in which you interpret each of the question as well. So basically, this will be the set of ratios which you are required to calculate. Okay. This will be the set of ratios that you are actually required to calculate. So you might be required to calculate the gross profit margin. Then you need to calculate the operating profit margin. Then the inventory days, the receivables days, as well as you need to consider the payables days, current ratio, quick ratio, interest cover ratio. And in addition to this, when it comes to the paper AAA, you need to calculate the effective tax rate as well. Okay. So consider that the company's gross profit margin and operating profit margin, you have calculated both. So, well, this is not much applicable for AAA, but still you can make sure that if there is any point in relation to this, you can include the risk as well. So consider that if the gross profit margin and operating profit margin of the company is moving on in the same direction. If both the GP and the operating profit margin is moving on the same direction, there won't be any much risk because both are moving on in the same direction. If it is to the upward or downward, there's no issues. But if both are moving in inverse relation like this, if the GP margin is increasing and the operating margin is decreasing, so that's what we call as inverse relation. We will assume a risk in that area. When the GP margin has increased, we'll consider that the cost of sales is decreased. When the OP margin is decreased, we will consider that the operating profit margin is increasing. So cost of sales is decreasing, operating expense is increasing. So there can be chances that expenses that need to be included within the cost of sales might be misclassified into operating expenses, thereby leading to overstated operating expense, understated cost of sales. That will be the risk here. So we'll be explaining like this. The GP margin has been increased and the OP margin has been decreased. Therefore, there can be chances that the expenses that need to be included within the cost of sales might be misclassified into operating expense, thereby leading to overstated operating expenses and understated cost of sales. Is that clear, everyone?
Yes, sir.
Consider that the receivables days has been increased significantly. So when there is significant increase in the receivables days, and if it is mentioned anything in the scenario, like there are something that affects credit worthiness of the customers, there's always a possibility that there will be bad and doubtful debts for the company, for which the company should have either created a provision, allowance for the bad and doubtful debts, or the bad and doubtful debts should be written off from the financial statements. If not, receivables will be overstated and the related expenses will be understated. Is that clear, everyone? Yeah. Next, it's with regarding the inventory days. Consider that the inventory days of the company has been increased. So it represents a possibility of having slow-moving or obsolete inventory. So if there is any slow-moving or obsolete inventory, there's always a possibility that it have to be written down to the lower of cost or NRV. If not, what will happen? Inventory will be overstated and the related expenses will be understated. Then, after this, you can consider all other ratios together. The one I have actually differentiated these ratios into two colors. Let me ask you guys, is it better to have an increase in the amount of GP and the OP margin or a decrease in these amounts? Is it better to have an increase or a decrease in the GP and OP margin?
Increase.
It's always advisable to have an increase in the amount of GP and OP margin, right? What about the receivables, inventory, and payables days? Is it better to have an increase or a decrease in these amounts? Decrease. What about current, quick, and interest cover ratio?
Increase.
It's always better to have an increase amount, these amounts, right? What about the gearing ratio?
Decrease.
Decrease. And if the GP, OP margins are increasing, it's good. If the receivables, inventory, and payables are decreasing, it's good. Current, quick, and interest cover ratio needs to be increased, then it's good. Gearing is increasing, it's not good. So you have to pick all the adverse ratios. So the GP margin is increasing instead of the, other than that, all other ratios are in adverse situation. So you have to pick all these ratios together, and you can mention that all the adverse will give rise to uncertainty relating to going concern. If there is any uncertainty, it needs to be adequately disclosed in the financial statements, but there are chances that company might not have done that. Is that clear? Is that clear, everyone?
Yes, sir.
Okay, fine.
Yes, sir.
Then, this is what we need to usually do in the area of AA. But when it comes to the AAA, just by having some set of adverse ratios might not result in going concern uncertainty. So you have to pick other things from the scenario. If the scenario also symbolizes that there are some uncertainty, we can mention it. Or else you can consider the possibility of having working capital difficulty, which might create financial risk for the company, which needs to be disclosed in the financial statements. But there can be chances that company might not have done that. Clear? Is that clear, everyone?
Yes, sir.
Yes, sir.
Yeah. Then, in addition to the ratios computed, we need to calculate the effective tax rate as well. Consider that the previous year tax rate was 20%. So you have to take tax divided by profit before tax. And in the previous year, it was 20%. And for the current year, it's 15%. And when it comes to the effective tax rate, 20% and 15%, you need to consider the profit as well. The company's profit has increased as compared with the prior year, but the tax rate have decreased. Is that a reasonable change? No. When there is increase in the amount of profit, either the tax rate have to be same or should be increased. If not, there can be chances that the company might have taken inappropriate tax rates. Clear?
Yes, sir.
Perfect. Then, next, we need to consider, in addition to these factors, the scenario-based analytical procedures as well. So when it comes to the scenario-based analytical procedures, see, we will be getting scenarios like this. Just a moment. Yeah, we will be getting scenarios like this. And the examiner will ask you to evaluate the audit risk on the basis of the analytical procedures. So when you get questions like this, whereby the examiner might be asking you to analyze the audit risk on the basis of analytical procedures, you need to compute the ratios which we have calculated. In addition to which, you need to do one more thing. First of all, as usual, you have to read the scenarios properly. Okay. And after reading the scenario, just a moment, after reading the scenario or during the time on which you read the scenario, you need to make sure that you are cross-checking the scenario to the financial statements that is provided along with the question as exhibit. Okay. So just a moment. Consider that when you read the scenario, see, it might be mentioned in the question that the company is having a new associate. So when a company have got a new associate, definitely there should be corresponding treatment in the company's financial statements, right? So, well, we know that when the company have a new associate, there should be treatment in the company's SOFP and P&L. So when there's a new associate, there will be investment in the associate that need to be shown here. So they have shown it here during the time they have got a 12 million value. And they have mentioned it here that they have acquired it for 11.5 million. Currently for the year end, it's 0.5 million increase. Probably that might be due to the addition of profit figure. So in that case, well, we know that we follow the equity method for accounting of associate, and profit from associate should be shown as a single line item in the P&L. And as we can see over here, it's not included. So it can be mentioned as a risk. So you need to compare the scenario to the financial statements. Then they have mentioned it over here that they have made an investment in the investment property and it is recognized at fair value. So the company have invested in an investment property. In the prior year, it's 7.5 million. Current year, it's 10 million. So there's an increase of 2.5 million. They have followed fair value method. So well, we know that when it comes to IAS 40 investment property, fair value gain or losses have to be recognized in the P&L. So we have to look at here whether they have included the amount within the P&L. But unfortunately, they haven't, right? They haven't included it over here in the P&L. Instead, the increase of 2.5 million, out of which 1 million is reflected within the other comprehensive income, which is not appropriate because we used to include only revaluation surplus amount here. And rest of the 1.5 million is missing. So you have to mention all this together as a risk. So you have to mention that during the time of the current year, company have a fair value gain of 2.5 million, which have to be recognized within the company's P&L. However, out of the 2.5 million in total, 1 million have been included within the OCI, which is inappropriate. Rest of the 1.5 million is either omitted from the financials or might be misclassified into some other head, which reflect in a total misstatement of 2.5 million in the company's current year financial statements. You have to mention it as a risk. Is that clear, everyone?
Yes, sir.
And after comparing scenario to the company's P&L and SOFP, then you have to start with the SOFP. So once after completing the total scenario, you need to come back to the SOFP. You have to compare the current year and the prior year balance to identify any unusual variance. So as you can see over here, the company's current year PP is 45 and the prior year PP is 45. Is that a usual variance? Definitely not. It's something unusual. Because if the current year and the prior year value remains the same, there can be chances that the company might not have carried out the depreciation computation, which is inappropriate. Again, when it comes to the investment property, we have already mentioned that. In comes to the intangible asset, current year and the prior year value remains the same. Even though the company have not charged any amortization, still there is possibility of having impairment. If the impairment review is not done, the impairment expenses will be understated, value of intangibles will be overstated. You can consider using this for computation of ratios. Then you can use the share capital figure. Consider that if the company have become newly listed and issue shares, definitely they should be split between share capital and share premium. If not, amount will be misstated. If the company have got an investment in a new subsidiary, which is a partial acquisition, in that case, there will be value of NCI here. There should be. If not, you can mention it as a risk. You have to consider the changes in retained earnings importantly. It was 34,000 it is 34,000 in the current year, and for the prior year it was 24,600. So there's a difference of 9,400 a year. For the current year balance, there's only 9,700. Sorry, there is a profit of 9,700, and out of which only 9,400 is reflected within retained earnings. So rest of the 300 is missing. So either they may have provided as dividend or might have been used for some other purpose. For let it be any purpose, extensive amount of disclosures have to be provided in relation to that. But if it is not done, it might reflect a mistake. You can mention that. If there is a bank loan which the company have taken, which is mentioned in the scenario, there should be increase in the amount of non-current liability. If not, non-current liability will be understated. Or if the amount of bank loan remains the same, you have to cross-check it with the finance cost. If the finance cost is having any variance, without having a variance in the amount of liability, it might represent a mistake in the financial statements. Again, in addition to that, we can consider the possibility of having trade payables. If there is any increase in the amount of trade payables, you have to consider whether it is usual or unusual. And you have to compare it with the scenario-based information. Then you can compute the GP and OP margin using this data. You can consider the possibility of having variance in the amount of revenue. Consider that it is mentioned in the scenario that the revenue will be the base figure for determining the amount of bonus payout for the directors. There can be chances of having intentional overstatement of revenue. So you need to consider the scenario to understand this, and you need to cross-check it with the data provider. You need to compare current year and prior year revenue balances to understand whether there is any significant variance. So you have to consider the other figures, or like operating expenses and other figures. And if there is any unusual variance in any of these figures, you can consider the income tax expense figure to calculate the effective tax rate and consider whether there is any possibility of having variance or unusual variances. So this is what you need to consider while evaluating the risk in relation to analytical procedures. Is that clear, everyone? Paka?
Yes, sir.
Okay. So this is how we will be analyzing questions from the area of 50 marks. So this is how you will be getting 50 marks question. And this is what we need to importantly revise to start with the question practice. Okay. All right. So that's it, guys. So this is what we need to discuss as part of the current session. And we'll be having a full-fledged question practice on the very next session. Okay. All right. So that's it, guys. Thank you so much. Thank you. Bye.
Thank you, sir.
Thank you, sir.
Thank you. Bye-bye.